Hey everyone, how's it going? JD Strategic here. I hope everyone's doing great today. This video, I'm going to be talking a little bit about a potential car market bubble. So, we've seen stock markets go up like crazy. We've seen the crypto markets go up like crazy. Housing market goes up like crazy. Car markets going up like crazy. Watches are going up like crazy. All these assets are going up at a crazy price, and we've seen that trend over the last couple of years. And now we're seeing stocks come back down, we're seeing crypto come back down. We've seen housing market kind of take a slight pause, so we'll be curious to see how that plays out. But the car market's one that has been accelerating at such a crazy pace. So my prediction is that it's going to slow down at some point. But I want to kind of dive into some of the numbers that are causing this, what's happening now, and like where we can kind of see things playing out. So I really do think this kind of plays into the theme of the page, and just all these different assets are going up at such a tremendous pace. So it really does play into the psychology of what people are willing to pay for these assets. So let's really dive into this video. But first, I just want to point out that nobody can predict the future. I definitely can't do that. But we can use the past to kind of better prepare ourselves for what's going to happen, and just looking at the past and saying X, Y, and Z may have led to this. And no, although there may have been some other factor that also led to it, but you can kind of use those factors to get an idea of where things may be going. So I think it is important just to study up the past, especially when you see common themes of stuff that's happening today and stuff that may have happened in the past, and see how you can do what you can do to better prepare yourself. So let's really dive into this video. And we'll have a chart for you guys to show first. So what's happening? So 10 years ago, Americans took out nearly $30 billion per month in auto loans. And as you can see today, that number is about over $60 billion per month. So this shows it on a quarterly basis. But you can really see the tremendous growth like leading up throughout COVID basically. And this growth has been kind of unprecedented throughout the last 10 years. So it is interesting to see how things will play out. But yeah, this is an interesting graph that really caught my attention, that really points out, these are all just loans that people are taking out. So it's kind of increasing the debt wave. So what are some of the factors that are causing these cars, new cars and used cars, just to be at such a crazy price right now? So part of it is just this major chip shortage that we've been facing. There's a global supply chain shortage. A bunch of our chips come from Taiwan, and there's just a huge global supply chain shortage. So if we aren't able to get those materials as easily, it's going to lead to prices going up. And another huge factor is during 2020, all these car manufacturers shut down, so they weren't actually building cars. So the inventory went down at a crazy rate. So that alone is going to lead to, car prices going up. So those are just some of the factors that led up to this. So let's keep moving on. I know we kind of got a long video for you guys, so please stay with me. So let's kind of talk about some other numbers. So the average prices of a used car has risen by over 40% just in the last year. So the used car prices and the new car prices have actually outperformed the stock market in the last couple of years. So this is pretty interesting. But 82% of consumers right now are paying above sticker price. So that's a pretty crazy number, especially when you think about just a year ago, that was 2.8%. And then at the start of 2020, right before COVID, this number was at 0.3% of consumers who were willing to pay above sticker price for a new car. So what does that mean? These people are willing to pay a premium to take out loans. So why are these people willing to take out loans? So the average American on the road right now, their car's been on the road for 12.1 months. So when you think of that, that would be kind of a long-term investment. So people are more comfortable taking out those loans knowing that it's more longer term. So people are more comfortable taking out that 6-year loan knowing that it's more longer term. But people need to realize, unless you're paying 0% interest on these loans, you're really just agreeing to make more payments over a longer period of time. So you're putting yourself into more debt because you're willing to pay this premium price for these assets right now, rather than kind of wait for it to come to you. So that's kind of something that's pretty interesting. People are willing to pay more on these. And some of the similarities I'm seeing is just between the housing market and the '08 crisis, when everyone was getting approved for these loans. So the big question is really whether these people are able to make their payments or not. So let's really get into this one. Just this headline: the government is warning against a wave of car repossession. So that's saying the government isn't too confident in all these loans that were given out on cars. So that's a really big hint that we could be in for something like the '08 housing crisis with cars. Although I'm not going to go that far to say, but the prices of these cars definitely will have to go down at some point, just based off this crazy growth. So another stat that's pretty interesting is the percent of loans extended for over 72 months or longer has grown in the last couple months. So what does that mean? These people that are taking out these loans, they're extending it, so they're willing to pay more. But it means that they're not able to make those payments now. So that kind of ties into this '08 housing market crisis where people weren't able to make their payments on the house anymore. So we're starting to see some of those themes in the car market. So that's something that I find pretty interesting. But overall, some of my final predictions is that in 2020, like I said, people weren't making cars. That's changed now. People are making cars. So, I mean, the inventory is going to go up at some point. So that should allow prices to kind of go down at some point. And also the chip shortage, which I spoke about earlier. When you just look up the chip shortage and when it's expected to end, or it's not going to end because there's such a strong demand for these chips. It's really needed in like an iPhone, a car, everything that we use. What was I really getting to there? But the supply chain shortage, it's going to end at some point. When you look up the chip shortage, JP Morgan, all these big companies, they're saying towards the end of 2022, we can see the chip shortage start to ease a little bit because the demand is so high. So it's not going to just stop, but it'll ease out a little bit as we kind of figure out the supply chain shortage, which will allow for these prices to kind of go back to more of a normal rate. And also one thing that I would like to add is when there's a recession, there's huge amount of layoffs. People are getting fired from their jobs. And whether or not that we do go into a recession, we have already seen crazy amount of layoffs, especially in the tech industry, which hired like crazy during the last couple of years. So now they're laying off people. So it kind of plays into this theme of crazy growth over the last couple of years. And now things are going down at kind of a tremendous pace as well. So it will be interesting to see how things play out. But as people aren't going to work as much, people don't need to drive as much. So that demand for transportation isn't as high. So that should also allow for the pricing of the cars to go down as much, or at least a little. So overall, I'd like to end it with this, and it ties into this huge investment theme. And this is Warren Buffett's quote, which I've spoke about before. And that's when you need to be fearful when others are greedy. So greed never plays out well in any situation. So when you're greedy over all these assets, it's going to come back to bite you in the long run. All these people are signing up to pay more money over the long run. So it is important to just be a little bit more fearful when others are greedy and kind of play out the market. And when others start to feel fearful, that's when you can get greedy and start to invest in those assets at that discounted price rather than that premium price that 82% of consumers are willing to pay right now. So if you made it to the end of this video, I really appreciate you guys tuning in. Thank you so much. I'm really curious to see where the car market goes. JD Strategic out.